So this isn't going to be long class really. Um, I want to make this a little more geared towards you guys. And I'm not going to be going over basic stuff, but is there any so I'm assuming a lot of you trade iFVGs. Is there any questions or examples or anything that you guys have like regarding iFVGs, regarding the market that you kind of want me to go over? And again, it's only going to be about 30 minutes, but I think it's going to be helpful. I'll do a separate class on daily bias, not today. Okay, let me just read some. All right. How do you recognize? So, first one, this is going to be an easy answer, but what are some ways you can recognize bad market conditions? The main thing I look for is, okay, this is going to be, most people already know this, but was Asia / London big move? Okay, if you generally get like more than like a 50-point move during these sessions, I'm really cautious going into the AM session. Now, this is where London, so here's London. Before open, we went from London 471 all the way to 609. We made over a 100-point move before the market actually opened, which you can see on Friday caused this really bad price action in the beginning of the day. So I think that's the main way that I really debate. Now, there are a couple other ways. Like, do we have FOMC later? Is there CPI? Like, if there's CPI, don't trade London. But I think it's like I think it's really mainly like, is the overnight move big? If it's more than 50 points, generally I consider that big, and I don't like to touch anything. I think that's really the main part of it for me personally. It's yes, there's going to be occasional 10 o'clock news where it's going to be like flash PMI, and I won't want to trade before 10. But the majority of the time, price action typically is not as bad before like 10 o'clock news as it is if we get a big overnight move. Does that make sense? Type 1 if that makes sense. That's like the main thing or main summary that you should get out of that, really, in my opinion. Exactly. Another thing is if you're noticing like a ton of volume imbalances or just a ton of little gaps, that's also a sign of bad conditions. So like that's another good sign. So like we had a lot of volume imbalances here, like right here. And obviously if you guys don't know what a volume imbalance is, it's when we get these gap between the opens and closes of candles. But you can see like on Friday, lots of these little volume imbalances. That is one way you can tell if price is going to be bad or not. And again, the more we get, the more they're all going to be filled, and the more they're filled, the more price is bad, or the worse price is going to be, because the market's going to try to reprice to all these volume imbalances that we did not fill before, and it's just going to create drop. So that's definitely another indication. All right. I see a lot of people. One of the main questions I get with iFVGs is what time frame do you use them on? And they kind of gave me a little example. They go, on Friday there was a fair value gap that was inverse on the 2 and 3, and they're like, how do you know which one to use? Because as I teach, right, as you guys know, I teach, we always want to take the singular fair value gap. It has to be singular, okay, or it has to be an obvious one. Obviously, there's another fair value gap in this leg, which does affect it a little bit, but this is the most singular, obvious one. Okay, same thing as this one here. Okay, so that's what I'm really looking for. Now, when we get the singular one, well, what if there's a singular one on the 2 minute as well as a 3 minute? Which one do you use? Okay, this is like the number one asked question I get about iFVGs. It depends on what you think the bias is. You know how that talk I had on my YouTube about like conviction? There's going to be plays where I have conviction in and you don't. I know where the bias is and you don't. If you ever see an iFVG and it's on the 2 minute and the 1 minute, wherever it may be, all right. For example, I'm pretty sure this is 1. Okay, actually it's not 1. Okay, but let's say it's on the 30-second. Okay. So it's an iFVG on the 30-second, and it's an iFVG in the 1 minute. Well, how do you know which one to take if they're both there and they're both singular? If you're really, really confident about the bias, okay, if you're confident, really confident in the bias, then does that mean you can take the 30-second before the 1 minute closes? Yes, you can. But you have to have a lot of conviction in the bias. Okay, and that's my answer to those people. They go, well, if there's a singular one in them both, the 30-second, the 1 minute, and 2 minute, how do you know which one to take? It's always going to be the one that, if you're confident, you can jump the gun. You can take the earliest one that closes, but you have to be really confident. There has to be a lot of engineered liquidity above, and in this example there is, right? Because there's a ton of stops here. Okay, you're gonna see it's all built up. Like the guys who have their stop here are gonna trigger these stops. It's gonna trigger these stops. It's gonna trigger these stops. Equal highs here. So this is one where I would jump the gun and take it on the 30-second, 1 minute. But if there is no stops right here and I was really unsure in the bias, or I was unsure of the bias, do you really think I want to take a, do you really want to think I'm going to jump the gun in the 30-second? Absolutely not. Does that make sense? I'm going to wait for every single time frame to close if I'm not confident about the bias. And there will be times where you get wrecked. On Friday, I took a losing trade. I took a trade, and you can see right here, the 1 minute closed above here. Right, the 1 minute closed above. The 2 minute closed above, and this is where I took the trade off of. So I kind of waited for the 1 and 2 here because I wasn't so sure. And I took the trade when he closed over. The 3 minute did not close above. And it just goes to show, at this point in time, we had equal lows. My bias is wrong. And of course, you can wait for every single time frame to get closed above, right? You can do that. That's up to you. But are you going to miss a lot of RR doing that? Yes. So if you are confident about the bias, you can jump the gun earlier in the earlier time frame. And that's really my answer to a lot of these guys who have the same question. They're like, well, how do you know if there's a single 1 in the 2 and 3 minute, which one do I take? If you're confident on bias, take whichever one closes first. If you're not confident on bias, or you don't know where the market's going to go, wait for both to close. Now, imagine if I waited for both to close here. Would I have lost here? No, I would not have, because the 3 minute would have never closed. I would have never gotten my entry. Now, if I do wait for the 3 minute close, I also risk price hitting here. And if we hit this internal high and the 3 minute close above, well, I can't get in. So that's why I like to get in like on the earlier time frame if I'm really confident in the bias. Because oftentimes if you wait for the 5 or 15 or the 3 or whatever, it closes above and hits the internal liquidity at the same time. Meanwhile, you could have already been in on the 1 off the 1 minute close. So it's really a conviction thing. It's not going to, I can't teach you it. It's going to be a conviction and screen time thing depending on how actually confident you are in the bias. And you got to realize there were probably people in my live stream here on Friday who were bearish. So what do? They short this, and that's their conviction. They have their reasonings for being bearish. They have their kind of beliefs on why the market's bearish. Maybe they see lows we're going to hit or whatever. They think we're going to hit them, and they're going to lose. All right? And that's fine. It all depends on, are you bearish? Are you bullish? How confident are you? And that confidence is going to come based off of screen time. All right? You're not going to get that confidence unless you have a decent amount of screen time in this marketplace, because you're not going to see things repeat itself until you have that screen time. So the other thing I will say is, I don't know if anyone's back tested this, but iFVGs along with the CISD are very high probability. Very high probability. All right. Again, Ricks, that's fine. You can wait for the highest one, but you're missing out on so much RR, especially if I'm Butters and I'm waiting for the highest one, the inverse. Let's say I'm waiting for the 5 minute. Meanwhile, the 1 minute already inverse down here. And here's the thing. I don't look at the market in terms of iFVGs. A lot of people really mistake that. When I teach iFVGs, you all are like, oh, these are amazing. But is it truly the iFVGs making me profitable? No, it's my understanding and where the market should go. So I'll jump into a 1 minute iFVG that I see if I'm really confident bias, and it'll still work every time because I'm so good at finding liquidity and finding where the market wants to go. So that's really the thing that people they underestimate about me and my trading. Like I am a huge believer, and I need to see where liquidity. I like to know where liquidity is. The inversion model is just my entry model, okay, and it's a very good one. Okay, it's probably one of the. I think the iFVG is the best model you can ever enter with. I think it's better than the 2022 model because it is the 2022 model, but it just has an iFVG and it's just a stacked confluence, and that stacked confluence is just so good. So it's like, would you rather wait for the 5 minute and get in here, or do you rather wait for the 1 minute get in here? Because again, you should already know like if we're gonna inverse the fair value gap. When I see price come up here after sweeping these lows, after price holds a fair value gap, do you have to wait for this to be inverse to get in? Absolutely not. You do not have to wait for this to be inverse to get in the trade. Why? Because we're already taking sell side. We're not going to reject this. We already rejected it one time. We already took sell side. It's one of those fair value gaps where from screen time, you will learn we will not reject that. We're going to go through it. So therefore, what does that mean? That means you can jump an entry before the inversion. Okay. The inversion is just the model to enter off of. And a lot of people don't realize, like, they're like, oh, should I wait for this to be inverse? Meanwhile, I'm already in from like the 30-second because I already know it's going to be inversed before it actually does get inversed, right? And that's a big part in trading and having the screen time. And really good example of Friday is I was actually bearish, but I saw price. I was bearish for the day, but I saw price hold this hourly fair value gap, and I saw my model right here. And even though it's bearish, if you saw the signature in price, you saw BPR, you saw us go into an hourly fair value gap, would that make you want to be bearish? No. And that's where people they don't want to switch their bias, and that's fine. But I'm still taking a signature model, even though if it's good enough and we get enough confluences, for example, this confluence here would be a BPR holding an hourly fair value gap. It's a signature in price I love. If I'm bullish enough, I will take this even though my bias is different, because this tells me, oh, my bias is wrong. Because if we were bearish, we would reject. I know, like, I have little scenarios in my head based off of screen time. I know if we should break through a fair value gap or not. If I'm bearish, I'm waiting for this to break. And, sometimes that might not happen. But if it doesn't break, you have to ask yourself, well, do you think I could be wrong here? Is there enough engineered stops to the opposite side? Is there a possibility I'm wrong here? And in this situation here, even though I was bearish, I still ended up taking on Friday because I was like, okay, well, we have all this low resistance liquidity now. Going into the market open right here, was there any low resistance liquidity? No. Did it make sense for us to dump? Yes. But then once I see all this, it's very difficult for me to be bearish. I'm changing my bias. I'm going to be short-term bullish until this kind of works out. So that's just what a good trader does. Like, the ideology is the market moves to hunt stop losses, as we know. And if you see enough stop losses generated in the opposite way of your bias, that's probably a good sign, because a lot of people are thinking like you. They think the market's bearish as well. But that's when it's time for you to switch your bias and be like, oh, well, these guys are all probably short in this trend line. They're going to get stopped out. I'm going to change my bias and how long. And I like what Tactical Traders, or Justin, he says about the market's constantly feeding you data every single candle. Your bias could change based off of something that happens, and that's just what happens sometimes when you take these iFVGs. But it just goes to show you, iFVGs will tell you the bias. They'll tell you if you're wrong or right. If we don't reject the fair value gap you think we're going to reject, that might mean your bias is wrong, because generally you're sure to reject it. So it's so important. Okay. All of BPRs, by the way, for anyone wondering, it's when we kind of have a double fair value gap lined up like this. That's all I'm gonna say about that. So again, Houseway said, why those blue ones fail? Well, for one, this didn't fail. Okay, this didn't fail. Why did this not fail? There's a fair value gap here, so should the stop? So there's an iFVG here, so should the stop loss go under this one? No, it shouldn't, because if I put the stop loss as a close under this one, we could still bounce off this one right here, and that's kind of my logic and thinking about it. So this one didn't fail. Okay, we still had one that we were holding from down there. That means your stop has to go into the last possible one, which is why I do the singular fair value gaps. Now, why this failed? Does anyone know why this failed? There's a simple explanation to this. Yeah, exactly. The market left equal lows. Okay, if I draw this here, okay, and I go to replay mode, all right. Watch this. Sometimes this is what I mean by the market's constantly feeding you data. Are these really important to me at the moment here? Is this important to me? Yeah, I mean, this doesn't really stand out to me much. I mean, it's all right, but it's just like, I don't know. Now, play a few candles. Is this now important to me? Yeah, now that becomes very, very important to me. The market fed me new data. My opinions change. This is a much more risky play versus if we did sweep that low, this would have been a fine play. Does that make sense? Okay, so that's why this play ended up failing. And I always say, don't trade between equal highs and equal lows. So there's equal highs here, which I get, but there's also equal lows down here. We could have done this for all I care. We could have done that. But if we don't do that, we're going to do this. We're going to do this. And you don't know which one's going to happen first. So you wait till we get to one of these edges. And then that's when the light bulb should be going off in your head. And you're immediately looking for a trade here. Okay, and that's why I don't take a setup. As you guys know, my rules, I don't like to touch a setup with equal highs and equal lows below. All right, because you always run that risk of, okay, you could still be right, but the market wants to run this instead first. And I think that's what happened to ICT Stream. He was right. He had the buy side marked right, and the market went down before it went up. And that's the risk you're willing to take. So, okay. And again, if there's an SMT, that's fine, but that's the only time I really ignore equal lows or equal highs. So if there's an SMT and we're in between equal highs and equal lows, I do not trust that SMT. If there's an SMT off of equal lows and there's equal highs above, then I don't care about that too much. It's only when we're trading in between equal highs and equal lows. No matter if there's an SMT, whether it be bearish or bullish, I still don't trade in between equal highs and equal lows. You can do that if there's only equal lows and equal highs on one side, all right? Also, time of day matters as well. Again, when I teach on my YouTube, you guys got to assume most of the teachings is for kill zones only. I do not trade Asia for London or New York kill zone only. So that's going to be important as well. But I mean, yeah. And also the other thing about this is if I play some candles, I mean, is this truly obvious to you right here? Does this stick out to you guys right away? This fair value gap here? Yeah, exactly. It's not obvious. It's not something that new ICT traders will come to the market and be like, oh, bearish fair value gap here, and they see this right away. Do you really think new traders are going to see this right away? Probably not. All right. It really depends on them, and most people will not see that right away. Okay. Fatality. I'm going to do a class next week. A guy's going to come in and do a psychology class. So, So that's all I got for now. This isn't truly mechanical because you're still using a bias. You still have to determine, like, do you know how far below sell side we're going to go here? No, not until you see a reaction. Is this truly a reaction? No, this is not a reaction. You have to let a few more candles play out first. A lot of people ask me, how do you know which sell side and buy side to use? I don't know if this is going to be important until I see the reaction. As soon as I see this candle, I now know in live time this is going to be important versus before, maybe I'm not sure. Does that make sense? And that's kind of how that's why I won't mark these. I'm not going to go into the market marking every single level. I mean, if you look at Empire Steve's channel, he has liquidity marked at every single low and every single high. I don't do that. I note them and I watch for the reactions from each of them. Okay. Again, if you don't know what an iFVG is, make sure to watch my YouTube. Okay. If anyone new here is in here and they have no idea what I'm talking about, this is not a beginner level class. Make sure to go to my YouTube. Make sure you watch ICT 2022 mentorship. Make sure to watch the My Strategy playlist on my YouTube. Okay, that's going to be your first start. Do you like an inverse more if the fair value gap got often rejected? Yeah, so I talk about this in my course a little bit. And by the way, I'm going to do, so beginning of February, for anyone wondering, I'm going to do a discount on my course and joining my live. Like, so it's not going to be just a discount on my course because that would be really unfair to people who already bought it. It's going to be like a package discount, which is not going to be, it's not going to be a major discount, but a package discount to where if you buy the course, you'll get like 2 months of premium free or whatever. So I'll do that if anyone's interested. But wait, I don't know what I'm going to do for that yet. Just know it's coming. But that's something I talk about in my course. If we ever reject the fair value gap multiple times and then go back to it with a lot of momentum, that's the only way I'll trade it. So if you guys saw my YouTube video about the trade I took on Friday, we rejected this 2 times. Okay. What's really the thing that makes me want to now take it? What's this thing here? Exactly. The fact that we got momentum back through makes it like, okay, after the market struggled to reject this or struggled to break this twice, I mean, it's really the momentum back through. It's like, okay, the light bulb just immediately goes off my head because look how easily this broke, right? This is all these people getting stopped out, which is going to trigger all these stop outs right here, right here, right here, right here, right here. It's going to trigger all these stop outs, and that's why I like it. Now, would I have liked it as much as if we were to just kind of slowly like lollygag through it and then like barely close above? Would I have liked it that much? Yeah, probably not. Because the lack of momentum is telling me in my head, oh, I don't see a lack of momentum here. Does the market truly want to break this? It's a yes or no question. You can tell. I could tell the market wanted to break it here because not a single red candle. We get 1, 2, 3, 4, 5 doji candles, 6, 7, 8, 9 red candles on the 30-second chart, and not a single red candle. What is that telling you about the market? What is that telling you about the momentum? That tells you that that's probably going to be a good long setup. All right. Enoch just asked a good question. Do I take the same setup if I get stopped out of break even? The answer is yes. If I'm looking for a high to be hit and I get stopped at break even, let's say here, and then we get another entry up here, I will re-enter. If I get stopped out for a loss, let's say, and I still have the same idea, I do not re-enter. If I keep getting stopped out for break even the same play, like for example here, let's say take this 30-second iFVG and I see price, we make a new internal high and then we hit it. This is right by my stop at break even, and I get stopped at break even here. I will keep looking for re-entries as long as I don't take a loss. As long as the idea remains the same. as long as structure is still supporting my narrative and what I want. But if I take a loss, I'm done until that setup completes, because that's just too emotional. I don't want to keep re-entering the same setup I keep losing on. Fatality. Yes, I do in this situation. This is, if we ever make a new internal high after iFVG and then hit it, I put my south break even, because I know the market should accelerate here if we are truly bullish. And I know if it doesn't, I'm probably going to get stopped out, and it's probably going to be a loss anyways if I don't get stopped for a break even. So, Eli, so this is on Friday. As you guys know, I always put my south break even at the first internal high. Now, on Friday, I actually did not, because I was so confident in this low resistance liquidity all being broken, because again, you got to realize, like, these plays are legit. These plays are the plays that retail traders can succeed on because of how good they are. I know from my experience, the market, not only when we hit the first internal high, it typically goes and breaks every other high. So here, 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 here. So if I have the conviction for that, do I truly need to move my south to break even? No. I could wait for like a higher internal high in this situation and then move south to break even. It's really just a feel thing based off experience, and that's why on Friday, like, I didn't move my south to break even until he got up here, because at that point I'm like, okay, now we've run all this liquidity. I expected us to run this and break it more, okay? And that's what I do. Does that make sense? Yes, I will post this on my YouTube. No, I don't. Ram, if you guys have a goal of, okay, I should make this many pips or this many points on a trade, if you have that rule, you're going to fail. You have to go into a trade looking for a good setup, not looking for the number of pips you're going to get. You don't be like, oh, I see a setup, I'm going to only hold it to 20 points. That's not how trading works. All right. If the iFVG closes way above, let's say the iFVG closes up here, would I probably get in the trade? Yeah, probably not. Now, could I get in the trade and show off to you guys and see, like, oh, I know where the market's going, I could get in the trade and show you guys? Of course I could, but should I do that? No, it's not good risk reward. And there will be times where you're going to have to watch a trade play out without you. You might know where the market's going to hit, and that's fine, but you're going to have to watch it play out without you. I'm doing a challenge with the private people in my Discord this week, and basically what I'm doing is, the challenge I'm doing is this. On Tuesday, we're all going to look for a textbook play. I'm going to fade it on purpose, and I'm going to take a loss on purpose. Well, some people might not do this, but if you're undisciplined and you are very emotional, well, then it's good for you to participate in, because, again, there's going to be days where you're going to have to take a loss. You're still going to know the market goes, and you can't keep revenge trading. And the only way to teach that to you is by you taking a loss and practicing. Okay, how does practice makes perfect? You're not going to get better without practice. Practicing taking a loss and not over leveraging. Most people can't practice that because they can't do it. So that's going to be one of the challenges we do on Tuesday. But again, feel free to participate if you want. I have a little challenge journal in my thing, so people are hopefully going to... looks like there's about 27 participants right now, which is good, but that's something we're doing this week. I do not use standard deviation for my target. Okay, I prefer liquidity, because although the market sees standard deviations, it knows liquidity better, and I think liquidity is more reliable than using standard deviations. Now, when we're at all-time highs, can I use standard deviations? Of course I can. But do you think I'm going to have as much conviction in a standard deviation than if I were to use liquidity? Yes or no? Will I have enough conviction in a standard deviation? Exactly. Why not? Why won't I have as much conviction? Yeah, it's like, it's a projection. It doesn't mean it's going to hit. And I've used liquidity for so long where that's where my conviction lies in. He trades. Maybe he has more conviction in a -4 hitting than I do. I don't use it enough. I don't know how the market reacts to it. I don't know how much the market targets it, and that's just something that that's why, like, when we're at all-time highs, I'm just gonna have to target like at least a 1R. Maybe I do use standard deviations, but does that mean it's gonna hit every time? No, it doesn't mean it's gonna hit every time, right? So yeah, this model is worth trading in London session for sure. Again, liquidity, I agree. So Dave says it's more of a magnet. I think, yeah, I agree. Liquidity is more of a magnet than standard deviations. Okay, totally agree. I do not. I mean, I don't use breakaway gaps. I don't teach breakaway gaps. I think a breakaway gap is you should know what fair value gap should not be retraced to based off your experience. That's like a big thing in this market. Like if there's equal highs above and we form a bullish fair value gap, typically price will not retrace to the fair value gap before hitting the equal highs. Like it's just something that's going to come with time. Carts. NQ moves $20 a point. MNQ moves $2 a point. That's all you need to know per how many contracts, and then multiply that by the number of contracts you get. Exactly. And like Tennessee Dave said, if the liquidity lines up with the standard deviation, of course it's going to be more probable to hit because that's a standard deviation and liquidity, right? So it just makes sense. So any specific ways to journal? I used to do it in a notebook, but I would do it in like journal and like Notion. So how much cash is needed for a futures account? It depends on the broker. And which combination do you use the CISD with your inversion model? I can't really answer that. It's whenever CISD appears within or before an inversion. It makes inversion high probability. Time decay, I would say about 80%. So yeah, you could swing using iFVGs, but gonna be harder. So again, don't forget. So if you guys don't already know, if you're coming from Forex, okay, do not start using your own personal cash. Start with a prop firm. And I know some people don't like Apex, but I would use Apex. They have an 80% off sale. It ends tomorrow, I think. Again, you can just use code Dodgy for the discount, but you do not need to use your personal cash. That's not going to help you because you're going to blow it. I would buy like very cheap Apex accounts for like $20 or $30, depending on what size you get. If you get like a 100K, it's like probably $40. And just buy a few of those, and that's your practice. Do not put, if you're coming Forex, do not put personal money into a live count yet. Okay, just trust me. It's not worth it. I mean, Apex is going to teach you way better. It's so cheap. You can buy Evo accounts. It feels a lot more real. And once you've traded for long enough, it makes you so emotionless. Like it's hard. It's just, I don't know. It's so helpful. So again, you can just look in prop firm links for that. I do care about news. There's certain news I don't trade before and trade. Again, I talk about all this in my course. This is all scattered information on my YouTube. Okay, like for example, this week we have NFP. I'm going to be on a demo account on Thursday because I don't trade the day before NFP. On Friday, I'll trade a live account, but it depends on the news. Depends on like if we have FOMC, if JPOW speaks, whatever. There's not a set answer to that. All right. Which one's better, Top Step or Apex? Really depends on the trading style. If you're trying to practice a new strategy, Apex for sure, because the Top Step account's more expensive. So January 19th. The drawn liquidity was higher on January 19th because we didn't hit this yet. And all the momentum is going to where? The next high. Where's the next high? Right here. So I knew this was a drawn liquidity. Pretty obvious. This is just a momentum play. and we are delivering from a fair value gap here. So when I see that, I know the market's going to shoot up to this next high. On Top Step, I think it's 2,000, John D. I do backtest on FxReplay, but I don't, only sometimes. And yeah, I trade NQ, which translates to ES and YM as well. So. Oh, 2,500. Can I go through the top 5 trades of the week? No, go to my threads, or go to my thread on my Twitter. I made one. So I usually do top 5 inversion fair value gap setups of the week. And I know a lot of people think it's hindsight, but most of them I actually do call live time. But sometimes the RR varies based on your conviction. And I still would recommend looking at them because the repetitiveness of looking at the signature and price is going to make you so much better, even if you don't see it at first. So yeah, just click that thread. So that's going to be it for now. RAM, yes, that's a valid model. Actually, no, that's not a valid model. Sorry. We take out the internal liquidity before it actually works, so that's not valid. So we take out the internal liquidity, then retrace. You want to get in before that internal liquidity is taken out, which in that it was basically impossible to get in. And that's what I do. Again, doesn't mean you have to do it, but all right. What's my bias of the week? I'm doing it on my weekly newsletter. I'll make a video later about it. So make sure to sign up for the weekly newsletter in my YouTube. It's my YouTube description. So that's all I got for now. I'll see you guys all later. And let me, again, you can DM me. My DMs are always open with any questions. And yeah, that's it for now. I'll see you guys later. Peace. But before you guys get off, just know this is a little more of a, some people might not understand like some things I'm even talking about. That's why, because they haven't watched the mentorship. Like, make sure you're watching my YouTube videos first. Like, these are not beginner level classes. They used to be, but I've done so many of them that you can just go back on my YouTube and watch them. So that's all I got for now. I'll see you guys later. Peace.